Hey everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to real estate investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But in today's video, this marks another episode of my monthly M1 Finance series, where I'm trying to build a $100,000 portfolio in this platform, M1 Finance. I've got tons of different videos going over this platform and the cool features that come with it, with the big one being portfolio rebalancing, that is automatic portfolio rebalancing, where you set target allocations and then you can turn it on to where whenever you add new cash into your account, it will automatically distribute it among your underweighted sections of your portfolio if you want to do that, or you can do it manually. I have that feature turned off right now, but it's a free brokerage nonetheless, so it's worth checking out. If you use my affiliate link in the description, you can actually copy my portfolio. I'm not a financial advisor, of course, but if you like to use this as a start, you can copy this portfolio directly into your M1 Finance account, and you can also see the specific holdings I have in there since I don't go over all of them in every single episode. But if you're interested in this sort of series, be sure to subscribe since I put out a new episode of the series on the 15th of every month, and I'm trying to track that progress again towards getting to that $100,000 portfolio. But I've made some pretty substantial changes to the portfolio in this last month. Where we last left off, I was actually selling off index funds. I had that Ben Felix slice, if you remember that. Check out the last episode if you're at all interested in that. But basically that slice had a bunch of index funds of the US stock market, which I think is getting very, very, very overvalued in many ways, at least from a broad perspective. Not that there aren't undervalued companies still, they're just much harder to find. And a lot of the overvaluation in tech firms especially was already caked into indexes, but I already have pretty large tech holdings in this New World Order slice here, which I would argue is my sort of guilty pleasure slice, which is just all mostly overpriced tech stocks, which I have not really been adding to at all. In fact, I might be trimming down from this soon. But if we go back here, I no longer have that passive index sort of slice to this portfolio. It made a lot of profits and I sold them all out. I'll pay taxes on them, of course, so that'll be fun. But I don't really want to be investing that way in this portfolio anymore. I really want to be focusing on when things are cheap and going for things that are priced below what I think their intrinsic values are. That's very hard to do and requires some actual analysis into each company, but I'd rather really know what I own and feel very confident in what I am buying. So that's what I'm going to try to do from now on. And I'm actually trimming down positions in this Joseph Carlson dividend fund as well. Although it has a lot of good companies in it, I think a lot of those are getting pretty overvalued, and frankly, it's a lot of stocks in there. So in fact, it has 36 right now, and I've been trimming some of the positions out of it already. So I'll be getting rid of that completely sometime in the near future, I'd imagine. I'll slowly get out of that because, again, the stocks in there are pretty good, but it actually mirrors a lot of Berkshire Hathaway as it is. So I thought, well, I can sell off most of the Joseph Carlson fund and eventually sell out all of it and then move some of that into the Berkshire fund, which is practically an index fund anyways. It just, they have a big cash moat and a lot of good things going for it. You have Warren Buffett at the helm, Charlie Munger, and other pretty powerful and smart investors and a big team there looking for undervalued opportunities at all times. And they have a lot of cash to work with, which allows them to get into some pretty unique deals as well. But that's definitely not the biggest change I made. The biggest change came over here in value. I actually added a few new holdings, or I should say a couple new holdings. One is this Pershing Square Tontine Holdings. This is Bill Ackman's SPAC. A SPAC is a special purpose acquisition company. It's essentially a company that is all cash. It's really a fund. So what Bill Ackman's doing is he has vowed to try and acquire a unicorn, which is a privately held company that is worth over $1 billion, which there are actually quite a few of right now, though a few just went public, so they're getting smaller by the day, I suppose. But that's Bill Ackman's goal with this SPAC. So he's raised a bunch of money, has some big people behind it. We have Seth Klarman, among many others, being part of this SPAC. They're all throwing money into this pool. So I thought, well, I have a lot of cash sitting around. I might as well put a little bit in here. I might not actually leave it in here, but if they get a deal announced, I'd imagine the stock would go up pretty handsomely. And I do trust Bill Ackman. I think he's a very savvy investor. Say what you will about him. He does have a pretty decent track record, to say the least. Not that he hasn't made mistakes. Every investor makes mistakes. But I thought I'd at least put some money there And this can kind of be my lower risk sort of holding, since it's just buying into a company that's all cash essentially. So there's no really risk of default. The risk would be he picks a bad company, but we don't even know what he's picking at. So there's some uncertainty there. If he picks a good one that people like, then you'd expect this to jump. It's $1,500 right now. And again, I might not keep that for the long term, but I did put some money there. The big holding, if you haven't noticed already, is the $9,000 or so that I have in Equity Commonwealth. This is a REIT owned by Sam Zell. Sam Zell is a very famous real estate investor who made big money in mainly the office space, but he has a bunch of REITs that he owns. This is just one of many. But the unique thing about Equity Commonwealth is, first off, I think it is quite undervalued. And it's really not that complicated to do an analysis on this company, in my opinion. I'll get into that in just a second. But you can see its performance over the last few years, or the last year or so. They just paid out their big dividend, which they pay out their dividends. It's a REIT, so they have to pay out their income that they earn generally, or at least they have to pay out a lot of it. That's the way a REIT works in order to get this unique tax status. REITs have to pay out their income every single month or year, or however they want to do it, but they have to pay it out at some point. So they do an annual dividend, and it looks like over the past couple of years, when they pay this annual dividend, the stock drops significantly, which makes sense somewhat, since investors are taking that money, and then if they don't want to be in the company anymore, they can leave, and they have some of the risk sort of eliminated because they got the dividend paid out to them. That happened again back in September, and the stock hasn't really recovered since. They actually announced slight losses, which I'll get into in a second, but they are sitting on a mountain of cash, and we're going to look at the balance sheet in just a second. But I wanted to add them to this portion of the portfolio, this value slice, which I think is eventually going to make up the vast majority of this M1 Finance portfolio. And this is with a focus on companies that I think are trading below what they should be trading and have some significant upside with limited downside. That's the ultimate goal with investing. It's not only producing maximum returns, but it's also protecting your capital as well. You can, of course, go into YOLO options, and that's going to have super high expected returns, but it's also going to have very little chance of actually protecting your principal if you're wrong. It's going to all evaporate. So it's super high risk, super high reward. The ideal situation is where you find something that has pretty good upside, but almost no downside because there's some sort of inefficiency built in, which you could argue that the stock market is very efficient. I would argue it's more efficient than real estate, but I'd struggle to say that it's truly efficient because there still seems to be opportunity sometimes where a stock is trading at below what it really is worth just on its assets alone. So I'll get into that in just a second. But Equity Commonwealth is a REIT that owns 4 major office buildings right now. Yes, office is not doing very hot right now. Office has seen a lot of problems with the coronavirus pandemic, and that's no good. And it's hurt a lot of office landlords since a lot of tenants aren't paying rent. I mean, maybe because they can't, or really because they don't want to, because they're not even using the office, and a lot of their revenues have been hurt anyways. So office is not doing really good right now in the short term. But these are 4 really high-class office buildings in 3 markets, in Washington, D.C., in Austin, and Denver. Equity Commonwealth used to have many more buildings than this, but when Sam Zell acquired it in 2014, he started selling off tons and tons of buildings. I forget how many exactly, but I think it was like 100 or something like that. It was many dozens. So he sold off a ton of buildings that he thought were at pretty attractive prices, so he got rid of them. Attractive prices from a seller's perspective, of course. So now Equity Commonwealth is sitting on this giant mountain of cash and has 4 buildings with, best part, no debt. So let's take a look at their balance sheet. You can see right here that you have the real estate properties, but let's focus on cash first. They have $3.4 billion in cash. And that's great because they also have no debt, no mortgages. You see here on liabilities, you have distributions payable, but that's the dividend they just paid out. This isn't every single month. So they've already paid that out. But you have the $3.7 billion in assets with 3.4 of it in cash. And really, this is a conservative amount of assets because this building price here, you have the land and the improvements, which I think they're just using book value. So the price they actually got these buildings in, which some of them they bought back in the 90s, for example. So you really assume that the 90s office price is the same as it is now? Probably not, you would expect. I haven't actually done a fundamental analysis on these building prices yet because incomes are so inconsistent right now. It's just not that useful to do an income analysis on an office property right now using today's numbers. But I'll go ahead and use book value here. This is the acquisition price they got it at, $355 million plus the $44 million equals about $400 million or so in building price and building value. But they've also got their accumulated depreciation here, which that's really just for tax purposes in real estate. The depreciation is something that a real estate company can write off and set against their taxes. So it's a useful thing in the tax code. But on paper, it's not as though the buildings are actually worth $142 million less. Now, if they go and sell these properties, they're going to have to pay recapture taxes on depreciation, at least I would assume, if I'm reading this correctly. I'm no tax professional. But saying that these buildings are actually only worth $257 million is very, very, very conservative. They're really probably worth at least the $400 million, plus maybe much more than that in appreciation, which I'm not even going to assume here. So really, they probably have closer to $4 billion in assets. And that's probably what the market cap of this company should be. It should be much, much closer to somewhere between 3.7 and 4.2. But instead, it's actually trading for $3.21 billion right now. So to recap, we have a $3.2 billion market cap based on this share price of about $26. But it has probably about $4 billion in assets because it doesn't have any debt. No mortgages on any of these properties. And even if the income is shoddy and they're taking a slight loss because they had to pay out dividends just now, they still are trading well below what their liquidation value would be. That would be if this company were to go bankrupt tomorrow, you're getting more cash back per share than you would pay to actually buy into the company. They have over $26 in cash per share right now. So you'd expect to actually get paid back money if they were to liquidate, which seems like an inefficiency to me. Maybe I'm reading this incorrectly. Be happy to have a discussion about it in the comments below. But anyways, looking at that, it seems like there is no significant downside, but there seems to be some pretty solid upside. They're in a very good position right now with over $3 billion in cash, and they don't really know what to do with it at the moment because the market is still pretty hot. So they're well positioned to take advantage of a dip in the market, or if they see opportunities come up. And that's something that Sam Zell has made his legend on. His legend comes from buying what are theoretically underperforming assets, making them really good, and then selling them at a much better price. So that's something he'd be looking to do with this company as well, with this REIT, and that's something that I think he's poised to do well when we reach some sort of crisis or when he finds attractive opportunities. Maybe it will be an office, maybe it won't be. That's his forte, is office buildings, but he's open to explore other types of real estate. His other REITs are in all sorts of different types of real estate. He even owns mobile home parks. So I don't know if Equity Commonwealth would actually get into that, but it is something to definitely keep an eye on. I think they're in a very good position. So again, what I think it has is some pretty decent upside and not really much downside because of how they're positioned with their assets. They don't have many liabilities, or really any at all. They have no debt on the properties. And even if they don't do well, they're still going to at least be able to float for quite a while since they have billions of dollars in cash. So it seems like a pretty low risk play, and I think something that could pay off pretty well in the long term. Right now, if they keep their dividend, it's at a 13% yield. So as long as I can pay that out for a while, and I'm at least getting about 13% of my money back. Of course, they could always suspend the dividend or reduce it. I didn't see any talks about them doing that in their earnings call, unless I just missed something and read it too quickly. But it doesn't seem like they're going to be cutting a dividend, and it's at 13% yield right now. So even if they cut it down, it still wouldn't be too bad. I know they're going to be able to pay it out if they want to because they have so much cash, and they're still bringing in some income from those 4 office properties. Hopefully they add more to the portfolio, which would be great, and then they'd be in an even better position because I think they're going to buy quality assets or do things that will make them much higher quality assets if they do purchase something, since that's something that Sam Zell has made his name on. So I might add another $1,000 to the position since I'm at $9,000 right now. It'd be nice to round it out to 10 grand since I think it is an undervalued opportunity. So I'm going to put some money on it since it seems like, again, low risk with decent upside potential. Not that it's going to explode in a day. It probably won't. It might take many years even, but that's what we're investing for. At least that's what I'm investing for. I'm investing for the long term. It seems like a good long-term option, so I'm going to go with it. So I think this REIT's undervalued, so I'm going to put some money into it. And if you guys think it's undervalued, definitely let me know in the comments below. What do you see with this REIT? Do you think it's a good opportunity? Do you think it's a bad one? Do you think it's one to steer clear of? I think maybe part of the reason it is undervalued right now is people aren't really into real estate right now, commercial real estate, and are just going for more tech opportunities. So I think it seems like a temporary dip in the stock that we shall see in the long term, of course, since I don't have a crystal ball, and we'll see what happens. But if you guys like this video, definitely leave a like, since that would help the channel out a lot. And if you'd like this series about my M1 Finance portfolio and want to see the progress as I make it, definitely subscribe, since I put out new videos for this series every single month, and I have other videos in between that about personal finance, real estate investing, and all that great stuff. So be sure to subscribe so you don't miss any new updates. And check out the links in the description for free stocks to Weevil and Robinhood. If you open up accounts there, you get free stocks. I get free stocks as well if you use my affiliate link. So it's a win-win. Do it and get the money while it's there, since there's no guarantee it will be for the long term. But until next time, take care.